Good morning. Welcome to the Brew Traders Workshop edition. Today, we have one of my co-hosts, Mark Phillips, with us today. And we're going to do something a little different. We're going to get to know Mark a little better. Take a look at his career path, how he got to where he is today. So this is the Mark Phillips interview day. So let's get to it with the opening bell. Here we go. Good morning, Mark. How are you?
Good morning, Lex.
I like
You know,
it. Yep, go ahead.
That this is perfect for August because this is what we used to do on the floor in August, right? There's no order flow, so we just used to sit around and shoot the breeze and get to know the guy that you were fighting with the rest of the year.
Exactly right. That's how I made some of my best pals. Even though they were my biggest competitors in the pit, they became friends, about August. You're about right.
Totally.
Right?
Yeah. Share a sandwich or two with each other,
That's for sure. So what I want to do today is, and we could go all over the board. There's no script for us today, but I want to let folks know you. I think you and I have a similar background at least in the beginning part of our careers. I'm not doing the same things you're doing now, but I think it's interesting your path because your insights are awesome. And we want to go all over the board. So we want to know everything. And I'll just see where we can take this. How's that sound?
Sure. Yeah, let's get into it.
All right. Good. Well, first things first. You give me the background on Mark real quick, the brief one, and I will delve deeper over the course of the show.
Well, so I think like a lot of people, right? Like the first time you saw the floor, the first time I saw the floor, I was like, I have to be down there. This is the coolest place. Like the activity, the energy, just the rush of being on that floor. I was like, I have to come back. And so I did an internship before my senior year of college on the Amex when it was over in its own building there on Rector and Trinity. And yeah, I saw it that summer and I said, I'm getting a job back here. I got to come back. I got to be a trader. This is the coolest thing ever.
Nice. And then did you, I don't know what kind of, if you can say names or not, but so how did you get your first job? Did you just go do the normal application process, say, hey, here I am, I'm out of school, I'm smart, and hire me? Or did you have some kind of contact or someone push you through a doorway? What was the path for your first job in the industry?
So in the options industry specifically, I had an uncle that was in the business. But finance in general, the years before that, I was just sending out cold, resumes, trying to get my way in any door. So I worked at an insurance company for the money one year. I worked at a hedge fund doing some data scrubbing. That was really interesting. But then it was a contact in the options industry that got me specifically into trading because I really wanted to trade. Like that was, seeing that from, browsing the investment industry broadly, it was like, having control of your book, being in charge of your P&L, like that was super, attractive.
Sure. And then you said you did that out of New York somewhere, right? That was your first foray?
Correct. So I was on the Amex as an intern. I came back, clerked on the Amex for a little bit. And then actually my first badge was on ARCA, ironically. So even though I, had been on the Amex was our office, we were trading, about 50% from upstairs at the time. So I was with Group 1 for my entire options career. But we'd started to move a lot of our business upstairs. And so I got paired with a team. We had a fellow who was an LMM on ARCA. And so he sat down there, he had his Skype headset on, and the three of us were back in New York upstairs, trading that book, managing the open outcry through him. So ironically, my first badged open outcry experience was over a headset.
Oh, nice. So what you mentioned a term. What is an LMM? What does that mean to the folks?
So every exchange sort of has their own flavor of them, and they all get slightly different sort of advantages and have different responsibilities, but it's the same as a DPM on the SIBO or a specialist on the Amex. And in terms of dealers, liquidity providers, when every product only has one designated primary market maker or one lead market maker is the LMM. And so that firm or that individual, that badge, gets special participation rights.
Right.
They have to be the first one out there to set the market. They have to be out within something like 5 seconds these days of the underlying print. They have to provide quotes at a given width electronically. They always have to be there given the response and open outcry. But they do, in exchange for that, they do get sort of extra participation rights, whether it's pro rata, they get like sub 5 lots electronically, they get a couple little, gimmies there, but the buck stops with the DPM or the LMM. They have to give that market.
Yeah. And I like to say when I talk about, that role, we were DPMs as well. But we come from the Chicago brand of it. So we called them DPMs. There's no real coffee break. There's no real vacation. Now, that doesn't mean you individually can't go on a vacation or have a coffee break, but your firm, who is the LMM or the DPM, is 24/5 in that pit, right? And whatever time goes beyond, the 5, you have to be making continuous two-sided markets forever. Yeah.
Yep. And that's tough, like, especially when those products first list or you're the first person trying to put a bid-ask spread out there. If you're used to trading something like SPY or Apple these days, you see stuff a penny wide. But when you had to put a quarter wide market out in something that you had no idea where that vol should be priced, or it's an ADR that's got a sketchy dividend stream or something like that, those are some of the scariest markets to put out there because you had no clue like anyone else, and you just had to be nimble and let the order flow dictate the pricing.
Yeah, so that's a good point. I think some of my hangups, as I'm sure were yours, was exactly that. You get a new listing, throw out that first set of markets, and then everyone pounds you one way or the other. They either sell you premium like mad because you're too high, or they buy everything from you because you're too low. In the open outcry part of our career, it was easier. You can say, yeah, whatever. Okay, my markets are wrong. Beat it. I'm going to readjust them. In the electronic world, there's no saying beat it. They just hit you. So you get filled up like a rainwater catcher.
Totally. And everyone's talking about zero DTEs right now. I feel like my biggest pain point was the leaps, having to open those leaps that are 2 years out. And, even trading on some of those exchanges where you got $5 and $10 wide, sometimes that wasn't even enough in those products.
No kidding. No kidding. Yeah. Good point. The leaps were like, how do I just say this? The leaps were like getting a tattoo. It never goes away. You don't get out of it. Once you have it, it's like there. It feels like forever, a leap. So you better be right.
Exactly. I mean, it's, not only are you losing on the trade, it's eating up capital, it's sitting on the book, those things are tough. We tried to stay away from those.
Right. Okay. So you started at Group 1, is that right?
That's correct. Did my entire market making career with Group 1.
Okay, good. And are you able to talk a little bit about Group 1 with their, they're still around? I know that. I know the answer to this question, by the way, but just want to hear it from your mouth. So tell us about Group 1 a little bit if you can. And be general, we know the game.
Yeah, for sure. No, still around, incredible group of guys. I mean, that's like one of the best things about proprietary trading is you meet some of the smartest, hungriest, most competitive, really interesting people. So, nothing but good things to say about them. And, great firm, great learning experience. I'd say our edge, our advantage was that we trained our own traders and we had our style and we stuck to it. And there are always tempting other opportunities. There's always like, oh, what's going on at the CME or what's going on over here. But I'd say Group 1 stuck to their bread and butter, evolved obviously through the whole electronic transition, like everyone had to 20 years ago. And they focused on names that were somewhat less liquid. Now everyone trades the whole gamut, and but without getting even into specific products, some of those lower liquidity names where we really like to kind of play. And we call them the tiers E's and F's, right? Like sort of the more than 50% of the names, but less than 10% of the volume. And biotechs, a lot of interesting special situations. I know you traded a bunch of special situations. So those types of takeovers, corporate actions, things where liquidity was expensive, right? Our edge wasn't necessarily in being the fastest electronic market maker, but being fast enough to use our wits to trade some of the lower liquidity space.
Yeah. So I think if I remember correctly, especially on the SIBO side of things, it's probably industry wide now that I think about it. The way they rated those stocks was from A being the most liquid, highest volume, all the way down, I think, to F was the lowest tier. if I'm not mistaken. Is that right?
Yep.
And then you guys like the D's, E's, F's thereabouts, and we were very similar to that. I think maybe we kind of fit in the middle, C's, B's. Hated A's, right?
Oh, they're so tough.
Yeah, the A's are tough, right? Tell us why A's are tough, especially from the market maker standpoint. Why would someone like you and me and our firms kind of steer away from A's when someone like maybe a Citadel kind of likes them? I don't know.
Yeah, I think it, obviously the volume's in the A's. That's why they're the A's.
Sure, exactly.
But the spreads are so tight in some of those. SPY trades like 8 million contracts a day. It's like 20% of the OCC volume or something. Maybe it's only like 18% of the OCC volume. But like every market maker I know hates trading it because there's no edge in it. By the time you pay transaction costs, by the time you pay hedging costs, by the time you're managing this whole thing, you're trading for fractions of a penny in edge there. Same with the top tier names like the Apples and the Microsoft. A lot of that top of book, like there's enough interest there that it can be customer against customer most of the time.
Sure.
As a market maker, you're not well compensated for providing that liquidity there. It's too tight, which is great for buy side, but if you're in the business of selling liquidity, you want to be in a place where it's a little richer, I guess.
Sure. Yeah, those are great points. And I tell folks, now that we've kind of morphed into retail, sort of, at least I have, into the retail side of the equation. Those types of A products are great for the retail person looking to assemble some sort of strategy because they don't pay that negative edge of getting into the trade or getting out of it for that matter, right? It's so, like you said, spiders are a penny wide in a lot of places, and they're trading millions and millions of contracts. So for a retail person, buy the offer, sell the bid is a pick a market almost, right? And for the market maker, I'm not even sure Citadel's, $1 at 101. They might be $1 at 104, and someone decides to be at 101 in front of them. I'm not even sure if they're playing the two-sided in that one very much.
No, I never traded SPY myself, but my understanding is that a lot of the strategy, you've got to pick your spots, right? You can't be on both sides of that whole curve.
Right.
It's the same way people would trade the SPX curve, even open outcry, right? People would focus on their niche in the curve, and you kind of try and get both sides of it. You can't be on every single bid and offer along that.
Sure. So as a market maker, put on the sneakers, put on the funny jacket, the funny tie. Well, I use funny ties. Some people look more professional than I did. Go down to the floor, right? So how long did that last for you? How long were you actually on the full floor, which will lead to my next question. When did you transition to being an off floor, electronic sort of market maker? Can you explain the difference in what your experience was between the two worlds?
So interestingly enough, I was upstairs before I went back downstairs to the true floor again. So
okay.
I was on our ARCA LMM team for a little bit upstairs. And then this was in the period when all those exchanges were shuffling around. So the NYSE had just bought the Amex, and they moved the Amex from its own building into the back of the NYSE. So when the Amex moved back there, our firm picked up a specialist post on the Amex and actually went back down to the floor, all the way back, and I think they called it the Blue Room, way behind the bell, way behind all those famous turrets where you see everyone sitting down there all day. We're in the back room, 8-foot tall ceilings back there,
nice.
Trading open outcry. And the game then was, it's not like what you see in the SPX pit or in the VIX pit, where Group 1 was a DPM. For as long as that existed in the VIX. But the order flow that we tended to see, and a lot of our strategy was kind of covering the different goals, right? That in a lot of ways, there's so many different places for order flow to trade in the options market that as a dealer, if your business is trading, you want to capture that. And every single exchange is a different goal. Every mechanism on every exchange, electronic, open outcry, those are all different holes where order flow could cross or trade without your participation. And if you trade and collect edge and that's your business and managing risk and inventory, like you need to cover all that. So being on the Amex was part of that. A lot of our electronic tools development was to capture that too. But we also physically set ourselves up in different places to intercept order flow.
Sure.
In a much more tactical way than it looks like in wild open outcry.
Yeah, understood. Yeah. Now, would you say did you manage the different places you physically existed, whether, physically meaning you had a presence in the market making part of it, would you manage those books individually, do you think? Or would it go into the gigantic portfolio of the firm and there's some hedge manager upstairs making sure all the Greeks are in line? How did you behave relative to the hedging part of it?
So for hedging and really risk management at the primary level always took place with the market maker individual that was managing that book. And, my badge was 01M, and 01M's portfolio as it existed in, our book. Like I had my P&L, if I was trading, Joseph A. Banks was one of the big names I traded. The reversal conversions were bananas in Joseph A. Banks. But I had to hedge my stock there. I had my own reg show failures that were distinct from our SIBO colleague that also traded Joseph A. Banks on the SIBO.
Okay.
And we could swap order flow. He might get 1,000 lot that comes in and he's like, I don't want to do all this. Like you take 200 and our guy on the Pecos would take 200 too. So there's a little of that, as the firm grow and continues to grow, like there has to be a lot more sharing of that. But fundamentally, we were individuals with books that we managed our edge and P&L and ultimately comp.
Yeah. So, just so folks understand that too, when Mark says P-Coast and Amex and SIBO, there were competitive exchanges in our business, right? And, SIBO kind of grew up as the start of it and the big boy. A lot of order flow was there. And then it started, filtering out across the country. So there's a Phillips.
Says a Chicago guy, by the way.
Says a Chicago guy. It's true, though. It's the numbers still hold.
Or the origin. I'll give you that.
And then we go to Phillips, we go to Amex, we go to P-Coast, right? Were those the major exchanges back when we were around on the floors? I think so. So you and Group One in our firm, we would have representation across all of those exchanges, even in similar pits. Why? Because in the early days, stocks were specific to exchanges, and then multiple listing came along, right? And then now other exchanges got to list, let's say Chrysler, for instance. So Chrysler predominantly traded in Chicago, but they had markets in Philadelphia, Pecos, and ultimately, it was across the whole board. So firms like yours and mine, we wanted to have exposure to all the order flow. So we put physically people in those pits. Some firms might kind of combine the books of similar products or like products. Sounds like you guys had them individually. You manage your book in New York. The San Francisco guy managed his book in the same product separately, right? I think that's what you're saying.
Correct. And, above all that sits, a macro risk manager. There's a firm risk manager. I think very well who our risk manager at Group One is.
I do. A good friend of ours. Yes.
Good fellow. But they're looking at the overall firm position, right? They have to say, if order flow tends to go the same direction no matter where you're sitting, and especially if people are chopping trades, but even if you're, electronically. So if all of a sudden everyone's getting short stock in Joseph A. Banks or short back month vol or whatever, paying too much carry in, XRT, which I definitely paid too much carry in XRT. They have to, the risk manager has to look at that at a firm level too. That those, you might have 5 guys, but they're not all going to be offsetting. So you might manage that at a firm level and say, hey guys, everyone's at their max. That means our firm's beyond our max. We need to trim this down.
Yep. Makes sense. So when did you make the transition from floor trader, market maker, right? What, you and I both did, to where you are now? And is there any in between story before we get to where you are now? So was there an interim step from going from floor trader to, I'm going to call it money manager, which is a metaphor for me, but you tell me exactly what you're doing now. And how did that happen? What went on there?
Yeah, so I was at Group One for my whole career before setting up my financial advisor. But sort of, I had a bifurcated career, both of trading, managing portfolios directly, and then my second half was sort of more on the business side of things. So everything market structure related, like what are the rules of the game and how can we capture this opportunity the best? Knowing why order flow dynamics move people to the Phillips, so maybe we need to get more resources over on the Phillips, and measuring the opportunity, how much volume trades, like a lot of data analytics, market structure analysis. And so I did that for the firm for a little bit, managing our overall liquidity footprint, because everyone wants to trade the hot new biotech. But if we have 10 guys aping in, to use the current lingo.
Yep.
That was not around in my day, but we certainly tried to ape into products where we could, but like that wasn't great from an opportunity capture at the firm level. So,
Right.
dealing with a lot of those kinds of questions. And so I was a Group 1 through 2019.
Oh wow, that's longer than I thought, by the way.
Yeah, almost a
Yeah.
full 15 years, just a couple months shy of 15 years.
Yeah, great.
And then it was at that point that I really wanted to build a strategy that would bring derivatives to everyone, which is the motto of my firm, Harvested Financial, and manage option strategies. Certainly not the market making strategies, but overlays, opportunity capture, collars, all the really cool things you can do with like options portfolio management. I made that transition by holding my nose and jumping, and I'm figuring it out as I go. But yeah, so that was how I crossed that bridge.
Right. So you actually did go get your RIA license, which I think is like a Series 65 or thereabouts. Is that right?
Yep, that's correct.
Okay.
And so you need to pass the Series 65. Anyone can do it. And once you pass that test, there are no prerequisites or anything like that. And then once you pass that test, you can register, and there's a ton of compliance stuff. But I know you know this well. Like the broker dealer side of compliance is not exactly easy, and you get enough training in it, and it just sort of becomes part of the business. So there's a decent hurdle there, but you're managing people's money, so of course you got to be tucked and tied for that.
Yep, and that's what you're doing now, right? Am I correct about that? So you're now managing money on the professional side, right? Is that accurate?
Yep. So my RIA run option strategies for individuals, advise institutions on it also. But then I also have a data product that is about analyzing market structure, analyzing, I have a custom set of spread indicators, I call them. So, I track risk reversals in different markets. I track condors in different markets, and use those to kind of signal how the curve's moving and set up sort of short-term opportunity capture ideas with this data product.
Okay, nice. I love it. Is the data product called Harvested Financial? What's it called? We're going to give you a plug.
The data product is called The Tape. So you can find me at harvestedfinancial.com. There's a bunch of information about my RIA as well as The Tape. And you can also try out The Tape at thetape.report. So a bunch of dashboards on there. There's a free version for Apple, so anyone can go and take a look at how this looks in Apple with real market data. But like I said, I look at a bunch of different spreads. I do some vol analysis, compare skew historically, and really it's designed to be a platform for identifying. So, hey, what's moving? This indicator popped up, or this skew just dropped quite a bit. Analyze, take a look at VRP, how fat that's been historically. Look at where the curve's out of whack, perhaps. Identify, analyze, and then ultimately execute on short-term trading opportunities.
So people who use that product could technically make their own decisions and trade themselves, right?
Correct. So it's not an execution platform. It doesn't have any connectivity for that. It's more for the active trader that's managing their own execution, managing their own sort of opportunity capture. Right. And I sort of have a complement newsletter as an educational component to it also. For people to sort of walk through the process and kind of get comfortable, if you're not familiar with all these different things, it's sort of an introduction to how to think about options market activity.
Yeah, that's great. So, and by the way, you mentioned that it's not tradable yet, meaning you can't place a trade on it, but we're going to work on that. We're going to work on that. We're going to get you connected over by us. Smells like a partnership we're going to work on, because we can make that happen, that part happen. And secondly, I want to make, a highlight here too for you, Mark, is that you are going to be a blog contributor to the Tradier web, right? So, or the hub, I'm sorry. So you're going to be contributing one of your free blogs to that entity going forward. Is that accurate?
That's accurate, and there's more even. So I sort of have 3 different little like blog silos in my setup, and one it'll be coming out today. It's called The Till, and that will be on Tradier's Hub, and that's it's sort of an editorial, high-level analysis of what's interesting about options markets from someone with a dealer perspective, but also as a financial advisor. So it's sort of a blend of those, stories of how to think about liquidity and floor dynamics. I'm writing about DPMs today.
Nice.
So there's some interesting nuggets in there. So that'll be up there. But then I also have, like I mentioned, my newsletters where I analyze trading opportunity, the sort of educational real-time tutorials. I'm going to be posting some of those and some previews of those there on the hub too. So help folks generate trading ideas and, think about getting out there in the markets.
That's great. I think it's needed. My biggest complaint about being an off-floor trader, retail trader, whatever you want to call me, something opposite from what we did in our past life, is trade idea generation. I think that is the toughest thing. Looking at the screen and saying, okay, what do I do next? And why? And how do I get out of it? And why? Right? So if there is great data out there, whatever form it takes, it is massively helpful, in my opinion, to the retail trader, right? I think it's needed. So,
I couldn't agree more. And that's why I wanted to set up a process around it, right? And go through and have a system that you say, okay, what am I going to look at? Where am I going to get some of these initial alerts and signals? And then what do I do with them? How do I learn more about it? And go through this workshop, this process, this, trade development kind of, criteria. And you find it points you somewhere, and it starts to tell a story that makes sense. And I think that's how you develop a thesis in this market.
Yeah. Yeah. Now, would you say that the things you find for actionable ideas, are they more around, the relationship of implied volatility to underlying, or is it more around direction and technical kind of indicators and breakdowns and breakups, or is it a combination of both? How would you describe, the sourcing of what you're trying to do?
Yeah, I'd say that at the end of the day, as a buy side trader, whether you're buying or selling or vol, when you're on the buy side, right, when you're coming up with those ideas, you need to have a thesis. Your thesis can't be, I'm in the options market to trade options for the sake of options. That's someone else's business. You have to come to the market with either a bull case on Microsoft, and that's why you buy stock and sell covered calls. Very simple options trade that says I'm lightly bullish on Microsoft stock. But you have to have some kind of bias. It could be vol related or whatnot. So I always like to start going down the path of what's my bull case, what's my bear case. And maybe the curve tells me I can sell vol and be bullish, right? And that's where I want to use a sort of broken wing butterfly setup that gets me short vol but leans bullish. Maybe I see that the downside of the curve, skews really big. That's a good opportunity to set my put spread at interesting levels so that I'm selling some of that fatter skew on the put spread, and getting a relatively cheap put spread if I'm bearish in that situation. So I let the curve sort of dictate the strategy, or whether I want to be debit or credit, and then kind of construct bull bear narratives around what either the options data is telling you, or because sometimes the risk reward can be bullish even if you're not bullish, and you can totally protect your bear side if the curve is call skewed enough, for example. So, I let the markets in some tell the story for me for what strategy I should use.
Got it. But it sounds like though, at its core, you still have a little bit of a directional bias, that's down deep. And then you let the market say, okay, with my directional bias, how do I best set this up? Right. And use the option analytics to say, vol's high, I'm going to take advantage of high volatility and my directional bias in the same breath, more or less.
Correct. If you're bullish, you could buy a call or you could sell a put. Like in a very simple term, right? Like, so do you want to sell the put because vol's bid, or do you want to buy the call because vol's cheap?
Yep. Perfect. Do you have a preference of which world you like better? I mean, I know what my preference is.
So I know what your preference is. As soon as you start asking the question, I know.
We go from the floor days to the off-floor days. I'm like, there is no question what's better in my mind. Yeah.
So I'm going to preempt your answer and agree with you that I like trading the credit side a little bit. But I think the beauty of options is that you can really risk manage that. So I like being short vol. I think volatility risk premium is real and exists. And I like that credit aspect of the trade. But that's where, I think my favorite strategy is the broken wing butterfly, because it gets me short vol. It gives me a little direction. It's like a spicier call spread.
I get it. Yeah. I love it. We're going to actually, when we're together again with Jason, we're going to take a look at the Manu broken wing again. We're going to revisit that one that we talked about a few weeks ago.
That's a good trade. Stock's up about $3 since we talked about it.
Okay. We might not be doing. I think we did the put side of that one, so we'll see. We'll have a look. That's good. Let's jump to the markets real quick. Mark, give you a breath and see what's going on. I mean, I have a couple questions about um, the markets in general, and they're not going to
Yeah,
be hard. Don't worry. Can you see this, Mark? Can you see what's going on?
I can.
On this?
Big green day.
Okay, so I get a lot of questions about this, so I'm going to ask you your opinion on this. When you look at something, this is CNBC, right? So when you look at something like this, we see the main U.S. markets: Dow Jones, Nasdaq, S&P. We got gold, oil, 10-year, the euro to USD, and the VIX. Okay, what should be important to a retail person as an indicator at large of the health or not health of the marketplace? Is it a combo of all this stuff? Do we have to understand everything, or is it just a couple little nuggets here and there? What are your thoughts there, if you have some?
Personally, my eyes are most drawn to the two figures with the S&P and where the VIX is. That if
Okay.
I, had just two data points that I could look at, I'd probably focus on one of those. I like the S&P because it's a little ironic to say now, just given how concentrated it is among some of those top names, but it's broadly diversified, pretty good benchmark, top 500 industrial names in the U.S. market. I think that's a
Mm-hmm.
decent sample. And then the VIX gives a good idea about vol.
Mm-hmm.
Obviously being an options person, you have to think about where that level is. Great index, interestingly constructed, I should say.
Mm-hmm.
So I think that does provide a good second point to okay,
Sure.
SPOOs are here and VIX is here. 30,000 foot view, those two.
Yeah. Okay. I think I agree with that. I think, I tell our folks, they ask me about gold and oil. I said, I got to be honest. I don't look at the commodities at all. I mean, it's just oil, just interesting where it is per barrel, just kind of as a talking point. That's about it. I don't know how you feel about it, but I'm not a gold oil person. I probably should be, but I'm not. I have to study up on that one.
I'm not particularly a gold or oil person either, and I think I alluded to that earlier when I was talking about different markets that you look at, and you're an options guy, and so hey, gold has options or oil has options, but they're different enough products that
Hmm.
like your equity experience only commutes so far with them.
Right.
And I almost feel that way about looking at those levels. It's like I don't own much gold. Oil only matters to the extent that I'm driving a car that takes gas. Like, oil matters in a lot of other ways, but they're just not my markets.
Yeah. Yeah. No, I agree. I agree with you on everything you said about, especially VIX. And I always preach the S&P 500. I'm trying to teach people that we call it the SPOOs, right? Back in the day. And that's the future. And I believe the U stands for the September future, if my mind serves me well. And it got its nickname because you could just say SPOO. But that was one of the serial expirations in the S&P 500 on the future side. So that's kind of to me, the main driver of what the market's doing. I think the Dow gets wonky, 30 products, right? A little bit. Even NASDAQ is a little wonky. I think, Apple and Tesla are such big, and Microsoft are such big parts of that. You can get wild swings with that one, right?
Yeah, and we've even seen it a little bit more with S&P. I mean, I don't have the exact figures, but 20% of that index is only in a handful of names. Is only in maybe 5, 6, 7 names.
Yeah. Yeah. I forget. I will do a show on this with Jason on the different types of indices. There's price weighted, there's cap weighted, and all that kind of stuff. We'll break that down on another show. So,
Yep,
all
those are
right,
fun
Mark.
products to trade.
Yeah, no doubt, no doubt. By the way, Jason's on vacation. I did meet up with him and his family in Chicago. He's doing a baseball diamond tour with his
Right.
young kids, which is awesome. So he went to a Cubs game, he went to a Sox game. He's doing Cleveland, so he's making a little Midwest to East Coast loop here. So he's going to be back in the box next week on Thursday.
Very good. Hopefully, with some special jerseys, we can guess who they are from.
Awesome. I love it. All right, man. Thanks for coming on. I love interviewing, folks like you from our past. You and I share a very similar past options world. So it's awesome for people to know, where it came from.
Very good. No, it's always fun to talk about the floor days.
We're gonna break into, since we have another similar interest in wine, and we'll maybe even spin it into wine futures and how that's all priced, and even have a little glass for while we're talking.
Very good. Well, my blog, to tout that again, my intro is all about monopolies and wine. So I get into.
I love it.
Yep.
I love it. All right. Well, very good, Mark. You have a great rest of the week. Thanks for coming on today. And that is a closing bell. See you later, Mark.